Hello everyone and welcome, Radek here, and this is a quick lecture on debits and credits. This is not going to be anything big, it's only introduction to the debits and credits, so please don't stress and stay with me. I'd like to start with emphasizing the fact that the correct use of debits and credits is extremely important when dealing with basic accounting practices, guys, and if you have the knowledge and ability to implement these items, will greatly enhance your chances to progress in the field of financial management. If you don't have a good grasp on what these concepts actually are, you will have a quite a hard time to advance through your career as a manager, pretty much in any field. So don't stress if the words debits and credits sound a little bit like a foreign language to you. You might be a little bit more receptive than you probably realize. These two words, debits and credits, have been around for about 500 years, so it's not a new concept. A lot of people have difficulties with understanding these concepts. Debits and credits are traditionally quite hard to understand, and that's because they're not very intuitive. So we have to come up with some rules to follow in order not to make mistakes when um, reading the books or preparing the books for a business or company. Under double entry system, every business transaction is recorded in at least two accounts. One account will receive a debit entry, which means the amount will be entered on the left hand side of that account, and another account will receive a credit entry, means that the amount will be entered on the right hand side of that account. Well, once you understand this, you have come a long way in understanding the whole discipline of debits and credits. The challenge now is just to know which accounts should be debited and which accounts should be actually credited and when. So before I explain and illustrate the whole methodology of deciding when debits and credits are used in accounting and bookkeeping, let's just discuss very briefly the actual accounts themselves. So what are accounts? To keep companies' financial data organized, financial managers or accountants developed a system that sorts transactions into records called accounts. When a company's accounting system is set up, the accounts which are most likely to be affected by the company's transactions are identified and listed out. The list is referred to as the company's chart of accounts. Depending on the size of a company and the complexity of its business operations, the chart of accounts may list as few as 30 accounts, or it might have as many as thousands. So every company has the flexibility of tailoring its chart of accounts to best meet its needs. Now about the different types of accounts. There is 5 different categories of accounts, and within the chart of accounts, the balance sheet accounts are listed first, followed then by the income statement accounts. In other words, the accounts are organized in the chart as follows: asset, liabilities, owner's equity, revenue, and expenses.
Okay, now let's have a look at how different financial transactions impact on each of these accounts, and how are different transactions recorded using debits and credits, the concept known as double entry accounting. So once again, we know that there are 5 categories of accounts. So I'm going to repeat that again. It's assets, it's liabilities, it's owner's equity, it's revenues, and it's expenses. It's only these 5 categories into which all accounts are grouped. All these different accounts are either debit or credit by nature. Asset and expense are debit by nature, which means that they have increasing balances on debit sides. Liabilities, owner's equities, and revenues are all credit by nature, which means that if the balances of these accounts increase, these accounts are credited. So assets and expense increases debit, while liabilities, owner's equity, and revenue increases credit. We also know that debits and credits are on the opposite side of the account, so we can express this simple concept on this little T account here, where the debits are recorded left and credits are recorded right. The decrease of any of these accounts balances would be recorded on the opposite side, which means that assets and expenses would be credited if their balance decreases. Liabilities, owner's equity, and revenue will be debited if their balances decrease. Okay, well, let's put it all together now. All you have to do is to follow these 5 steps. Number 1, determine the financial transaction. Number 2, determine the specific accounts that will be affected by this financial transaction. Number 3, what type of accounts are they? Are they assets? Are they liabilities? Are they owner's equity, revenue, or are they expense? Now, you have to determine the impact on the account's balance, and then using your little cheat note, you'll be able to determine whether it is debit or credit entry. Now let me demonstrate this on a very simple example using 4 different financial transactions. When I'm saying simple, it's because any business involved in trading will be making these. So what is trading? Trading essentially means 2 things. It's buying products or services or selling products or services. And there's 2 terms on which we can trade. We can be buying or selling things either for cash or on credit. So when we buy things for cash, that's a cash purchase. When we buy things on credit, that's a credit purchase. When we sell things for cash, it's a cash sale. And when we sell things on credit, that's a credit sale. So let's look at each of these 4 different financial transactions: cash purchase, credit purchase, cash sale, credit sale, and what impacts would they have on specific accounts. So first I'll start with cash purchase. The cash purchase will affect 2 accounts. 1, purchases, which is an expense account. The second account would be cash, which is an asset account. Credit purchase will have an impact also on 2 accounts, and these are purchases, again expense, and this time it's not cash because we haven't paid anything. When you make a credit purchase, you're promising to pay later in a specified period of time as stipulated by the credit terms. The person you bought the products or services from is your creditor. The next financial transaction is cash sale. Cash sale will affect 2 accounts. Number 1, sales, and the second one is cash. Sales is a revenue account, cash again is an asset. In a similar way, creditors will impact on sales, that's a revenue account, and on our debtors, the records of people who owe us money, people from which we will receive the money, and therefore we call them accounts receivable.
Okay, so now let me demonstrate to you how the different types of financial transactions, and we've got here 4 examples of the very simple financial transactions, how do they impact on the individual accounts, the relevant accounts that they will be recorded in. So a little refresher first. We know that each account has 2 sides. DR, that's debere, for debit, and CR, credere, that's for credit. We also know that there's 5 categories of accounts: assets, liabilities, owner's equity, revenue, and an expense. Now I'm going to write all this again: assets, liabilities, owner's equity, revenue, and expense. And we know that assets and expenses are debit by nature, which means that they have increasing balances on debit side. Well, that's actually the only thing that you need to remember, because if you do, everything else can be derived. We see that liabilities, owner's equity, revenue do not have increasing balances on debit sides, and therefore they will have increasing balances on credit side. So liabilities, owner's equity, and revenue increase their balances on credit side. Well, turn this around and it's as simple as this. Liabilities, owner's equity, and revenue therefore have decreasing balances on debit sides, and assets and expenses have decreasing balances on credit side. So let's use this as a little cheat note while we're completing posting into the specific accounts for these 4 different financial transactions. So one by one, I'll start with cash purchase here. Cash purchase impacts on 2 accounts, purchases and cash. Now we know that purchases is an expense account. Purchase is an expense. And the question I have to ask is, what happens to my expense when I make a cash purchase? Well, when you're spending your money, your expense goes up. Now we see that increasing expense up here is in debit column, so therefore purchases will be debited. Purchases are debited. The second account that will be affected by this transaction is cash. Now cash is an asset, and the question to ask is, what happens to your asset when you make a cash purchase? What happens to your cash? Well, when you make a cash purchase, you're spending your cash. It means you've got less cash, and having less cash means your asset decreasing. Decreasing asset, as we can see here, would be recorded as a credit entry. Now that's how you'd record a cash purchase. You would debit purchases and you would credit cash. Let's look at the second example here, credit purchases. Cash purchases or credit purchases for the purchase account will be exactly the same scenario. It's an expense that increased, and increase in expense is a debit entry, therefore debit account purchases. And we've got accounts payable as a second account. Accounts payable is a record of people that you're owing money to. Now, when you buy something on credit, you have to pay later. You're promising them to pay later. Accounts payable, the record of your creditors, is your liability. What happens to your liability when you buy something on credit? Well, when you're buying on credit, you owe more, and therefore your liability increases. Now, increase in liability, as we can see, is a credit entry. So we're going to credit accounts payable. So that's the second part to credit purchases. For every transaction, there is 1 debit and 1 credit. We see that for cash purchases, we also had 1 debit and 1 credit. So let's look at another transaction here. That's cash sale. Cash sale impacts 2 accounts. It's cash and the sales. Now we know that cash is an asset, and the question to ask is, what happens to our asset to our cash when we make a cash sale? Well, when you make cash sale, you receive cash, you've got more cash, and therefore your asset goes up. An increasing asset, as we can see up here, is a debit entry. So therefore we're going to debit the cash. What happens to your sales? The sales is a revenue account. Revenue. It's a good news. When you make cash sale, your revenue goes up. An increase in revenue is a credit entry, and therefore we're going to credit sales. So again, we see that there is 1 debit entry for cash and 1 credit entry for sales. The last financial transaction I've got here, the last example, is credit sales. Well, credit sales impact on 2 accounts, accounts receivable and sales. Accounts receivable, the people that owe us money, our debtors, we expect to receive this money, and even though we don't have the money yet, we treat it as if we do. So therefore accounts receivable are classified as an asset, a current asset. It's a record of people who owe us money. When you make credit sale, the balance of this account increases. People owe you more money because you sold to them and they owe you money. So the asset increases. An increasing asset, as we already know, is a debit entry. So we're going to debit the accounts receivable. And the second part to this transaction is to post into a sales account. A sales account, as we know, is a revenue account. What happens to your revenue when you make a credit sale? Well, surely you're getting more money, so therefore your revenue increases. An increase in revenue is a credit entry. So we're going to credit your sales. And again, we see there's one debit and there's one credit entry.